Active managers have outperformed passive ones in this market recovery. An industry executive explains. Plus, we'll explore the alternative asset class industry with a policy spokesperson. This is 7-Day Yield.
Welcome to 7-Day Yield. I'm Lydia Morrish.
And I'm Mitch Rochelle, and here's what's trending. As evidenced by the post-election equity market rally, many analysts forecast business growth in 2017. The recently released PwC CEO survey suggests that much of that growth may be organic. 92% of CEOs expect organic growth compared to 55% seeing growth from new M&A activity.
Cybersecurity risk sadly is here to stay. According to PwC's recent Global State of Information Security Survey, the most common type of cyber attack in 2016 was phishing. These growing risks in email compromise can be more effectively contained by adopting advanced authentication technologies, as well as implementing more robust employee training programs.
This may seem counterintuitive, but active fund managers have underperformed when compared to passive ones. Simply stated, active funds include traditional mutual funds, whereas passive ones largely include exchange-traded funds, or ETFs. According to a recent Bank of America study, in 2016, only a surprising 19% of actively managed large-cap mutual fund managers generated returns that exceeded their benchmark. To understand this growing trend of active fund underperformance, Lydia recently met with the CEO of ETF.com, Dave Nadig. Take a listen.
So we've talked a lot about active versus passive on the show, and obviously passive funds tend to still dominate. Do we see that with the current regulatory environment that trend is going to continue?
Yeah, there's a lot behind the move towards passive, and I don't see it slowing down anytime soon. Certainly regulation is going to be part of it. The Department of Labor fiduciary rule is definitely going to push more advisors towards low-cost beta products, and that really means ETFs. But it's also just a trend we've seen, honestly, going back almost 20 years. Mm-hmm. Active managers as a class have continued to underperform in this market cycle at least. And so low-cost, transparent beta is really the way of the future.
Mm-hmm. We've had active ETF products on the scene since about 2008, but we really haven't seen a lot of inflows into those products. So is there anything that's going to help move the needle towards active?
Yeah, I do think you're going to see traditional active managers show up in the space. We've seen some fixed income managers come in early with some name brands. That's really helped. Fixed income tends to be a place where managers are a little less worried that the guy on the street's going to front run their strategy. There's a lot more trading involved that is really unique to those firms. So fixed income is sort of what broke first. But I think it's only a matter of time before traditional long-only active equity managers enter the space.
Mm-hmm. So we're starting to hear a little bit more about smart beta products. Could you explain to us what a smart beta product is and sort of, whether or not we're going to see that trend take off as well?
I think of smart beta as anything but market cap. You take a traditional index and you do something different with that index to try to either lower your risk or increase your return. So it could be something as simple as equal weighting the S&P 500, or it could be something much more complex that's using factors to pick individual stocks, much like an active manager would. Mm-hmm. So the rise in smart beta has been, in a way, a leaning in towards active management.
So maybe it's sort of the middle ground for traditional active managers versus passive.
Yeah, and we've seen some active managers come to the ETF market first, not with their flagship active products that are run by human beings around analyst tables, but with smart beta versions of their strategies that are sort of conveniently connected to how they think about active management, but aren't really active management. It's been that sort of first baby step.
Right. And just looking at the regulatory environment, obviously I think it's going to have a huge impact on the asset management industry as a whole, but how do you see the regulations sort of changing the ETF industry the next 1, 2, 3, 4 years?
I do think that we're going to be facing a much more industry-friendly SEC over the next few years. And so some pending rulemaking, things like the derivatives rule, which would significantly change the ETF industry, I think it's likely those things get pushed out a little bit or at least come back for more comments. Other than that, I do think we're looking towards a very friendly regime for asset managers.
Joining us to sort of break down the ETF story or give us the 411 on ETFs, our very own tanned, rested, and ready Gary Meltzer. Love the tan. Where'd you go on break, Gary?
It was a little bit further south than New Jersey, which is always good, right?
Philadelphia? So, Gary, we've talked on the show before about sort of the old school mutual fund versus sort of the new school ETF, but is tension starting to build amongst mutual fund investors? I talked about the 19% beat in the benchmark. Is there starting to be certain tension in the system around that?
I don't think that we're going to see a change in the near term. I think that the tax efficiency around exchange-traded products and passive products, the ease in which you can invest and get in and out of those products, and the cost effectiveness of those products is going to continue to present opportunity to investors, right? So I think we're going to kind of see somewhat of the same course as we get into the further parts of 2017 than we saw in 2016.
One of our analysts referred to the battle between active versus passive as almost as a boxing match. So which do we see coming out ahead in 2017? Traditional funds or ETFs?
I think, first of all, you see convergence happening at the asset manager level, right? So you don't necessarily have solely offerings of active versus passive funds. We heard that in the interview as well. If it's smart beta or otherwise, managers are looking to be offering both. I do think that, again, certain things that we're seeing from a regulatory standpoint and how products are going to be bought going forward is going to continue to put an emphasis on passive funds. And I do think, and most will say, that as we get into 2017 beyond, it's likely that there will still be increased flows into passive products versus active products.
Good stuff. Thanks, Gary.
All right, thanks, guys.
After the break, we'll be speaking with the Chief Operating Officer of the Managed Fund Association. We'll be right back.
Welcome back to 7-Day Yield. Portfolio diversification and the desire for outsized returns have investors continuing to allocate capital towards alternative investments. PwC partner Mike Greenstein recently spoke to Marc Charon, Chief Operating Officer of the Managed Funds Association, to discuss the issues the industry faces and how policy might evolve. Take a listen.
So you're the Executive Vice President and the COO of the Managed Fund Association. Tell us about the role that the MFA plays in the industry.
So we really have, in essence, three missions. We advocate, we educate, and we communicate. We educate policymakers on the role and the benefits of a strong alternative investment industry and the role that we play in a well-functioning capital markets. And then we communicate. We speak on behalf of the industry when things go well, when things need to be corrected. And certainly, in terms of all three, they all tie together in terms of our engagement with policymakers on industry consensus positions, advocating our priorities.
So there's obviously a lot of change going on right now with the change in the political environment and what that is expected to bring. Sitting from where you sit at the MFA, you have a great purview of the industry. Would you say that there's more threats to the industry ahead of us or more opportunities?
It's a great question, and to kind of a little bit of a Washington type of answer, I'll honestly say both. The industry has been undergoing a lot of pressures, investor pressures, from fees to redemptions. Clearly over the last few, if not more years, a lot of regulatory pressures, and the list can go on and on. But with those threats, we really believe there's a lot of opportunities. We certainly believe that the hedge fund alternative investment industry model is a good one for investors. I think the opportunity is to play offense. It's been certainly, I think, a tough environment, but I think we'll be able to do so certainly now post-election.
Give us some thoughts on the prospects of change, the timing of change, and maybe even the focus of change. Obviously, we can't predict the future, but just what are you guys thinking about right now as you prepare for that?
So, Washington does not move quickly, and with the new administration, new Congress, things take time. So there's been a lot of talk of tax reform, but that, come January 20th, it's still going to take a lot of time, perhaps many, many months. For the industry specifically, those, the Deputy Treasury Secretary, the SEC CFTC chairs, there's open commissioners, most, if not all, of the division directors will be leaving. So all that takes many, many months. I think leaving politics aside and repeal, replace of Dodd-Frank, I think there will be a new construct when it comes to regulatory engagement. By and large, I think the industry is excited to engage with policymakers accordingly.
One of the alternative asset classes that's getting more and more attention is real estate. To give us some perspective on that is our very own Byron Carlock, who's back in Studio C. Welcome, Byron.
Thank you, Mitch.
Real estate's a hard asset, so people think about buying an office building, let's say, but let's think about it from an asset management, wealth management perspective and fund structures. How's real estate fitting in amongst all of those fund-owned alternative investments?
Well, so we've heard a lot of discussion around alternatives getting bigger allocations, and inside the alternatives universe, of course, is real estate, ETFs, PE, and real estate's getting a big chunk of that. And so what you're seeing is the branded asset managers are offering a nice menu to the investment community to choose according to their risk appetite and their return expectations.
Is that so that they can be responsive to the evolving needs of their customer base and not lose the customer?
Exactly, and also allow the investors to manage a smaller universe of asset managers. So the asset managers are being asked to do more and provide more products and more opportunities for the investors to choose from.
Byron, I know you're part of a real estate roundtable. How important are associations such as the MFA in terms of helping set policy?
The Real Estate Roundtable has been invited to a lot of the transition discussions because the president-elect seems to believe, and I believe with him actually, that real estate can be a big catalyst to economic growth. And so some of the discussion items that we've been involved in have been, whether or not the risk retention rules that just went into place, by relaxing those, could we increase CMBS volume, as an example? What can we do to inspire infrastructure spending? Because so much of our infrastructure needs to be improved to replace that which is dated. What can we do to inspire home ownership again? Because we're at a nadir in our history's home ownership percentage. And so those are all policy decisions that the Real Estate Roundtable can help shape with the new administration, because I think many of those things will be part of the President-elect's 100-day plan.
Great. We're going to have to leave it there, but thanks so much, Byron, and thanks, Gary, and thank you for watching.
Don't forget to check out our PwC YouTube page for all the previous episodes. Plus, you can follow us on the Twitter handle below. We'll see you next time on 7-Day Yield.